the 17th of March 2025. JP Morgan emergency announcement. $4.8 billion loss. One day, one commodity. Silver. Cannot close the position. Short 900 million ounces. The metal doesn't exist. Not in COMEX warehouses. Not in global mines. Not anywhere. $52 per ounce now. $79. JP Morgan fails. $100. 3 banks follow. Federal Reserve. 72 hours to solve it. But you can't print silver. You can't bail out physics. Welcome to Financial Rewind. I'm here to show you the crisis unfolding in real time. And today, we're inside the silver emergency. How JP Morgan built a position that cannot be closed. Why 900 million ounces is mathematically impossible. How $52 became the point of no return. And why the Federal Reserve is learning that some crises can't be solved with money. This is where finance meets physics. And physics wins. Let's start with how this position was built. Because this took 14 years. Silver hits $49 per ounce. Speculation drives it. Investment mania. Exchanges panic. Raise margin requirements. Force liquidation. Price crashes to $26 in 1 week. JP Morgan watches this happen. Sees opportunity. Starts selling silver futures. Betting price stays suppressed. The trade works. Silver drifts down to $14 by 2020. JP Morgan makes billions. But they don't stop. They expand 2020 to 2023. Silver hovers between $20 and $28. Stable. Boring. Perfect for selling options. JP Morgan sells more futures, more calls, more structured products. All bearish. Position grows to 400 million ounces. Then 500 million. Then 700 million. By December 2024, 900 million ounces short. That's 110% of annual mine production. More silver than exists in COMEX warehouses. More than JP Morgan could ever deliver. But risk models say it's fine. Silver has been stable for years. Industrial demand is manageable. No reason for concern. Until January 2025. Here's the trigger event. The 14th of January 2025. China announces massive stimulus. $500 billion for green energy. Solar panel installation targets doubled. 200 gigawatts to 400 gigawatts annually. This needs silver immediately. 160 million ounces required in 2025. Double the previous year. Buyers scramble for supply. Silver jumps from $28 to $34. 3 days, 20% gain. JP Morgan faces margin calls. Posts $2 billion in collateral. Executives think it's temporary spike. Price will settle. The 28th of January 2025. India announces matching program. 100 gigawatts of solar by 2026. Another 80 million ounces of demand. Silver hits $39. JP Morgan posts another billion in collateral. Starts quietly buying, trying to reduce exposure. But when you're short 900 million ounces, quiet buying is impossible. Your purchases push price higher. Higher price means bigger losses. Bigger losses require more buying. This is the doom loop. The 15th of February 2025. Silver breaks $45. JP Morgan has lost $3 billion. Still short 850 million ounces. Bought 50 million at massive loss. Barely reduced the position. Then March 1 happens. The event that breaks everything. The 1st of March 2025. Solar manufacturer demands physical delivery. Not cash settlement. Actual silver bars. 30 million ounces from COMEX. This should be routine. COMEX has 90 million ounces in inventory. Delivering 30 million is possible. Tight, but possible. But it reveals a pattern. COMEX inventory declining fast. December 2024 was 120 million ounces. January 2025 dropped to 105 million. February dropped to 90 million. Industrial buyers taking delivery. Not rolling futures. They need physical metal for manufacturing. The demand is real. Not speculation. Cannot be stopped by changing rules. More buyers demand delivery. Another 40 million ounces claimed. COMEX now must deliver 70 million ounces. From 90 million total, leaves 20 million. That's 2 weeks of normal volume. The exchange is being drained. Silver price explodes. March 10, $49. March 15, $51. March 17, $52 and climbing. JP Morgan's loss hits $4.8 billion. They announce it because hiding it is impossible now. Stock drops 23%. One day, worst decline since 2008. Let me show you the math. Why this position cannot be closed. JP Morgan is short 850 million ounces. Current price is $52. Total exposure, $44 billion. JP Morgan's market cap is $450 billion. Looks manageable, but derivatives don't work that way. JP Morgan sold futures at average price $32. Current price $52. Loss per ounce $20. Times 850 million ounces. Mark-to-market loss $17 billion. Already catastrophic. But closing makes it worse. To exit, JP Morgan must buy 850 million ounces. At current market prices, but buying that volume pushes prices higher. Market impact adds $10 to $15 per ounce. Real cost to close, $60 to $67. Times 850 million ounces. Total, $51 to $57 billion. That's 11 to 13% of market cap. One position, one commodity. But here's the final problem. The physical silver doesn't exist. COMEX inventory, 90 million ounces. JP Morgan needs 850 million ounces. Even at any price, the metal isn't available. Position cannot be closed. Not today. Not this year. Not ever at current supply. This is checkmate. Now the other banks. JP Morgan isn't alone in this. HSBC short 300 million ounces. Scotiabank short 200 million ounces. Deutsche Bank short 150 million ounces. Combined, 1.5 billion ounces. That's 180% of annual production. All facing same problem. Rising prices. Margin calls. Cannot close positions. Physical metal unavailable. HSBC announces March 18. $2.1 billion loss. Scotiabank March 19. $1.3 billion. Deutsche Bank hasn't announced. But it's coming. This isn't one bank's problem. This is systemic. Entire precious metals derivatives market breaking. And spreading. Banks used silver short profits to fund other positions. Leverage on leverage. When silver blows up, collateral disappears. Other positions liquidated. Credit default swaps trigger. Counterparty exposure cascades. Same mechanics as 2008. But instead of paper mortgages, this is physical commodity. Cannot be restructured. Cannot be extended. Cannot be negotiated. Solar manufacturers need silver now. EV makers need it now. Electronics need it now. The demand doesn't pause for bank problems. Physics doesn't negotiate. The 18th of March 2025. Federal Reserve Emergency Meeting. Present. Fed Chair, Treasury Secretary, SEC Chair, CFTC Chair. Banks present the data. Losses, $17 billion. Collateral shortfall, $30 billion. Systemic risk, critical. If JP Morgan fails, credit default swaps trigger. Estimated exposure, $200 billion. Counterparties, pension funds, insurance companies, sovereign wealth funds, cannot allow failure. Treasury Secretary asks the question, can we bail them out? Fed Chair explains the problem. We can provide liquidity. We cannot provide silver. This is the fundamental issue. In 2008, banks needed cash. Fed printed money. Crisis solved, mostly. In 2025, banks need physical silver. Fed cannot print silver, cannot mine it, cannot manufacture it. Crisis is in physical world, not financial world. Fed operates in financial world. Their tools don't work here. SEC Chair suggests halting trading, close the markets, freeze prices, give banks time to negotiate. CFTC Chair explains why that fails. Industrial buyers need silver for production. They'll go to London Metal Exchange, or Shanghai, or buy directly from miners. Closing COMEX doesn't stop demand. Treasury Secretary suggests forcing cash settlement. Change the rules. Make physical delivery illegal. Force contracts to settle in cash at frozen price. Fed Chair shakes his head. That destroys confidence in all commodity markets. If we change silver delivery rules, we can change anything. Gold, copper, oil, natural gas. Global commodity markets freeze. Trade stops. That's worse than silver crisis. The room goes quiet. Everyone realizes the same thing. There is no good option. Every solution creates bigger problems. This is checkmate for central banks. Let me show you the options they're considering. Option 1. Emergency lending to JP Morgan. Fed provides $50 billion loan. JP Morgan buys silver on open market. Closes position slowly. Problem. Buying $50 billion of silver pushes price to $80 or $90. Creates bigger losses for other banks. Triggers their failures. Solves one problem. Creates 4 more. Option 2. Borrow silver from foreign central banks. Bank of England has reserves. Swiss National Bank has reserves. Combined maybe 50 million ounces. Problem. JP Morgan needs 850 million. 50 million doesn't solve the problem. Delays it by weeks at most. Option 3. Force industrial buyers to accept delayed delivery. Buy 6 months of time. Hope supply increases. Problem. Manufacturers operate on contracts. Delays mean breach. They sue or buy from other sources at any price. Doesn't solve problem, makes it worse. Option 4. Nationalize silver production. Force miners to sell to COMEX at below market prices. Build inventory. Problem. Miners are global. U.S. produces 10% of silver. Can't force Mexican, Peruvian, Chinese miners to comply. Trying destroys U.S. mining investment forever. Option 5. Let JP Morgan fail. Let derivatives market collapse. Clean up afterward. Problem. JP Morgan is globally systemic. $9 trillion in derivatives exposure. Failure triggers cascade. Makes Lehman look small. Global depression. Politically impossible. Every option is bad. Fed is stalling. Buying time. Hoping something changes. But nothing changes. Silver keeps rising. $53. $55. $57. JP Morgan keeps bleeding. Now let's talk about winners. Because every crisis has them. Physical silver holders. People who bought coins and bars years ago. Holdings doubled in value. Bought at $20. Worth $57 now. Selling into the spike. Taking profits. Silver miners. Companies like Pan American Silver. First Majestic. Fortuna Silver. Production costs $20 per ounce. Selling at $57. Profit margins exploding. Stock prices up 100 to 200%. China. Accumulated 300 million ounces over 5 years. Average cost $24. Current value $57. Paper profit $10 billion. Plus strategic control. Silver for domestic solar manufacturing. For EVs. While Western competitors scramble. Russia. Increased production from Ural mines. Selling at premium to India and China. Outside dollar system. Using SPFS and CIPS payment rails. Bypassing sanctions. Making billions. Short-term speculators. Traders who bought January futures at $30. Selling now at $57. 90% gains. 2 months. Wealth transfer is enormous. From banks to physical holders. From short sellers to long buyers. From west to east. Quietly. Invisibly to most people. Measurably real. Here's the industrial impact. First Solar announces March 20. Production halted at 2 facilities. Cannot secure silver at viable prices. 20% capacity offline. Hundreds of workers furloughed. Tesla announces March 21. EV production reduced. Silver wire harness costs up 40%. Margins compressed. Production cut 10%. Stock down 12%. Apple, no public announcement yet. But suppliers reporting delays. iPhone 17 production slowed. Silver contacts too expensive? Either raise prices or lose margins. Samsung, similar situation. Galaxy S26 production impacted. Chip manufacturers struggling. TSMC. Intel reporting silver supply issues. Advanced packaging requires silver. Alternatives exist, but require retooling. Takes months. Production affected now. This is real economy, not financial markets. Real factories. Real workers. Real products delayed. Because one commodity is short. Shortage created by financial derivatives. By banks betting against physics. And losing. Let me show you the timeline forward. Pattern recognition. Based on current trajectory, the 25th of March 2025. Silver hit $60. More banks announce losses. Regional banks with silver exposure. Market volatility spikes. S&P 500 down 8% from peak. April 1, 2025. Fed announces emergency measures. $50 billion lending facility for banks with commodity exposure. Temporary suspension of mark-to-market accounting for silver derivatives only. Markets stabilize briefly. Silver consolidates $58 to $62. April Sinci Sprezeche, 2025. Industrial shortage becomes visible. Manufacturers issue warnings. Supply chain disruptions. Product delays. Price increases coming. Electronics up 10 to 15%. EVs up 5%. Solar panels up 20%. April 13, 2025. Silver breaks $70. Fed measures proving insufficient. Cannot stop physical demand. Cannot create supply. JP Morgan faces existential crisis. May 15, 2025. Forced merger announced. JP Morgan absorbed by Bank of America. Fed facilitates deal. Provides guarantees. Like Bear Stearns 2008. Except JP Morgan is Bear Stearns now. The 1st of June, 2025. Silver peaks at $79. The breaking point. Industrial demand destruction begins. Solar projects canceled. EV production cut permanently. Electronics shift to alternatives. Demand falls. July 2025. Silver declines. Demand destruction working. Falls to $65. Then 60, stabilizes $55 to $60. New equilibrium. Higher than before. Below the peak, crisis passes slowly. But damage is done. Banks lost $50 billion. Manufacturers lost billions. Climate targets delayed. Technology roadmaps disrupted. All because of derivatives. That should never have existed. Here's the regulatory failure. CFTC monitors commodity futures. Prevents excessive speculation. Ensures market integrity. They have position limits. Rules about concentration. But limits have loopholes. Swaps exempt. Options have separate limits. Across entities, banks build massive positions. JP Morgan's 900 million ounce short was legal. Reported to CFTC, approved. No red flags raised. Because rules written by industry, enforced weekly. Nobody thought silver mattered, until it did. Now CFTC announces investigation. After crisis. After losses. After bailout. Typical. Close barn door after horses escape. Congress holds hearings. Banks apologize. Promise reform. New rules proposed. Lobbying weakens them. Eventually passed. Watered down. System continues. Until next crisis. Different commodity. Same dynamics. Fundamental problem unfixed. Banks can bet money they don't have. Against commodities they can't deliver. When they lose, taxpayers bail them out. Moral hazard complete. Here's what individuals should watch. Not advice. Just signals. If you hold physical silver, consider strategy. Above $60 is extreme historically. Will likely revert eventually. Taking some profit is prudent. Not all. Some. If you work in solar, EVs, or electronics, expect disruption. Supply chains unstable. Prices volatile. Companies struggling. Job security decreases. Have backup plans. If you hold stocks in silver-dependent industries, understand risk. First Solar, Tesla, Apple, Samsung, all face margin compression. Production delays. Stock prices will reflect. If you hold bank stocks, especially JP Morgan, HSBC, Scotia, know the exposure. These banks face crisis. Even after bailout, reputation damaged. Long-term trust issues. If you're concerned about systemic risk, diversify. Away from financial sector. Hold cash. Hold commodities. Hold assets not dependent on bank stability. Because this reveals something. Banks are fragile, more than they admit. One commodity, one bad bet, can threaten entire institution. That's not strength. That's vulnerability. Let me address the counter-argument. This is fear-mongering. JP Morgan survived 2008. They'll survive this. Fed will intervene. Everything fine. These points are reasonable. Fed is powerful. JP Morgan well managed overall. 4.8 billion loss doesn't destroy bank. Silver will probably stabilize. Demand destruction balances market. Crisis passes. Maybe true, but here's what's different. 2008 was paper assets. Mortgages restructured. Debt extended. Timeline managed. Silver is physical commodity. Cannot restructure physics. Cannot extend delivery indefinitely. Cannot negotiate with industrial requirements. Constraints are real, not financial. Real. That's why this is more dangerous. Fed can't print silver. Can't mine it. Can't manufacture it. Their power ends where physics begins. We're watching what happens when finance meets physics. Finance lose. Maybe not this month. Maybe not this year. But eventually, the derivatives position too large. Physical supply too small. Something breaks. That's not fear. That's math. In 2011, silver hit $49. Crashed back down. Speculators forced out. Market normalized. Crisis averted. This time is different. Demand is industrial. Chinese solar isn't speculation. Indian green energy isn't speculation. EV manufacturing isn't speculation. Real physical needs. Won't stop when margin requirements change. Won't pause when exchanges intervene. Won't end when banks lose money. Demand continues until price destroys it or supply meets it. Neither happens quickly. We're watching slow-motion train wreck. JP Morgan bleeding billions. Fed preparing bailouts. Industrial production disrupted. Silver climbing toward $79. The breaking point where system admits defeat. Admits some things can't be financialized. Can't be derivatized. Can't be bet against forever. Because eventually someone needs the physical thing. And when they do, futures contracts don't matter. Can't build solar panel with swap. Can't power EV with option. Can't manufacture phone with short position. Needs silver. Real silver, physical metal, And at $57 and rising, world is learning there isn't enough. Never was. The derivatives created phantom supply. Paper silver that doesn't exist. Warehouses are nearly empty. Mines can't increase fast enough. Buyers need delivery now. Banks promised what they can't deliver. And physics is collecting. Welcome to the silver crisis. JP Morgan lost $4.8 billion. Betting against physics. Federal Reserve preparing emergency measures. That can't fix the underlying problem. $79 approaching fast. And only solution is pain. Demand destruction. Production cuts. Economic slowdown. Until supply and demand balance. At new, higher price. Everyone pays. For decades, because that's what happens. When you build system on derivatives, eventually you need the real thing. And someone has to deliver. But the metal doesn't exist. Not in warehouses. Not in mines. Not anywhere. And you can't print silver. You can't bail out physics.